I'm Dr. B, and yes, I'm a real ER doctor, so you may be wondering, what am I doing here in this space? Well, after years of pain from sports injuries, I listened to my doctor and had to pivot into a career that would keep me off my feet as much as possible. I also have a degree in finance, and so it was a natural transition to join Verified Investing. I'll share my prescription for becoming a successful investor right here on the Market Pulse.
Welcome to the Market Pulse. I'm Dr. B here at Verified Investing. What a week in the stock market. These are moves we haven't seen in years, and we are going to talk about them today on this episode. So let's get over to the charts. If you take a look here at the NASDAQ, all right, the NASDAQ was down 6.3% yesterday morning pre-market. That is huge. I have never seen that in my career. 6.3%, okay, down on the NASDAQ. All right, the NDX or the QQQ, right? The QQQ is an ETF that tracks the NASDAQ. The S&P was down 4.6% pre-market, right? The SPX or the SPY, okay? Those are huge numbers. We saw the semiconductors down huge. Essentially everything on the board was red. It was a fear-driven sell-off, but also probably an overvaluation sell-off, and also the fact that unemployment is starting to go up and jobs that were added last month is starting to go down. It's essentially a global, fear of a global recession, right? The Nikkei dropped 12.8%, the largest drop in the Japanese stock market since 1987. That is a huge drop. You had the European market selling off as well. So this is historic. This is a historic drop. Not quite as big of a drop as the 1987 flash crash, but definitely something that is on our radar. I think it's created a seismic shift, a change in the markets now, and I believe that this will mark the beginning of the bear market. Okay, I do think that we are likely to go into a bear market after this big of a pullback. Yes, I do think that we're short-term oversold. You are seeing the markets getting a bounce today. But I wanted to point this out. So this is very, very powerful. This was a tech-driven rally. This was a tech-driven bull market rally. And you can see here this parallel. Okay, not many people use parallels, but I believe that institutional investors, smart money, use parallels. Here's this first pivot low here from the COVID lows, the highs in 2021. All right, beginning of 2022. Here are the lows in 2023. And you could have called the top of the stock market so far by just putting a parallel here on the NASDAQ. You can see a huge 16% pullback from the highs to this low yesterday on the NASDAQ. That's correction territory. Anything over 10% is correction territory. So this is an amazing pullback. And again, you see this trend line here that we've broken. All right, not a perfect trend line. Here's your pivot low. Here's a pierce, pivot low here. And now we've definitely broken below, and now we're starting to come back. The question is, do we get rejected here and continue lower, or do we go a little higher before the final pullback? And of course, I've been wrong before. The markets could just go higher and higher and higher. Who knows? But the likelihood is after such a big pullback like that, and with the technicals here on the charts, the likelihood is that we are going into a recession based on the numbers. Credit card debt at all-time highs, personal savings low, jobs added last month dropping to 50% of what they were in June, about 220,000 in June, just 114,000 added in July. So big numbers to the downside, surprised the markets. Very, very interesting. So we're going to go over here and just take a look at the SMH. The SMH is the semiconductor, okay, ETF, right? So it looks at a combination of stocks, NVDA, AVGO or Broadcom, SMCI, a variety of semiconductor stocks. So you can see the same exact parallel pattern on the SMH. Had we just been tracking this the entire time, this combined with the NASDAQ, we would have been able to see this parallel and say, hey, it's hitting the top here. Look at that pullback. Amazing how technical analysis works. This is about a 30% pullback, okay, from the highs. I'm going to show you a couple other semiconductor stocks that have pulled back and really, really amazing. We'll go to NVDA next, and you can see here that NVDA has pulled back around 35% from the all-time highs. Okay, this was an unbelievable rally in NVIDIA. It caught most investors off guard. For those of you who were long NVIDIA, congratulations. But at some point we realized it could not last. We had a pullback here, beginning of the year, and now a much larger pullback after forming a topping tail here on the weekly. Big topping tail, retrace, and then a pullback here of about 35% on NVIDIA, previously trading at $140, and now the lows yesterday somewhere around $92, $93. It's rebounded now to $105 today. We'll take a look at, let's just see here, AMD. I wanted to show you this on AMD as well, and you can see that AMD also had a parallel channel here. Here's your pivot high, pivot low, pivot low. There's your pivot high. AMD is about 50% off the all-time highs, okay? 50+% off the all-time highs, all right? Unbelievable pullback. This is probably a buying opportunity down here at the bottom of this parallel, somewhere around 130, okay? It could be off, maybe it's 115, 120, don't quote me. But very important to pull up these parallels and understand, you know, how this works in the markets. So let's take a look at the S&P 500. So if you look at the S&P, you can see this same type of parallel. Now I had 610 drawn here on the S&P. Again, here are your pivot lows, pivot highs, pivot lows. Formed a nice, you know, immature parallel. You really kind of need 4 to make that parallel complete. So I was looking at 610 on the S&P, but really what makes sense is it's a tech-driven rally. We really should have been focusing on the NASDAQ as the main chart instead of the S&P, because that helped us mark at least the near-term top. It could end up being the top for 2024, but we'll see. I wanted to show you a pattern here that I found on the S&P on the hourly chart. You can see here that the S&P formed a head and shoulders pattern, very, very bearish pattern, especially when it's at the highs of the charts. Okay, left shoulder, head, right shoulder. You can see we broke down here. All right, so we broke down, big breakdown, gap down, breakdown. We came back up and retraced, and look at that fall on the markets there. Okay, this was our lows yesterday of about 510 on the S&P, and again the S&P was down off the highs around 10%, okay? Around 10%. I think it was like 9.68, something like that. But again, around correction territory. So now that we've had, again, and this is the measured move, right? If you haven't seen my previous videos or educational modules, you know, within or episodes of the Market Pulse, go back, watch the Market Pulse, and you'll learn these types of things. So to take the measured move on a head and shoulders pattern, you take the neckline here to the head, you take this same distance, and you bring it down here from where we broke down, let's say about there, and we actually went more than the measured move, okay? We actually went all the way down to here. And again, this is fear, overvaluation, and fears of a recession, you know? So pretty interesting. So, okay. We're going to take a look at the Nikkei. I wanted to show you that. What's really interesting about the Nikkei, this is the monthly chart. The previous all-time high on the Nikkei was somewhere around 1987. You can see that the Nikkei just eclipsed that value of around 39,000 just, let's see, here in maybe 2023, 2024. Okay, and what happened was we pulled back 12% on the Nikkei yesterday, okay, before our markets opened, 12%. 4.8%. Okay, that's the largest drop since 1987. And again, you can see back here on this chart. Here's 1987, somewhere like this, right? There it is. Looks the same, right? Pretty amazing. If you look on the rest of the chart here, you won't see this big of a drop on the Nikkei. So the other part I wanted to mention here is that, for my life, right, all of my life, you have seen the stock markets just going up and up and up and up over time, right? And so our generation, I'm a millennial, we are just kind of tuned, programmed to just keep buying the S&P, and that's a great strategy over time, and it has been for the baby boomers for sure, but look, what happens if you just keep buying? You just keep buying and buying and buying, and it keeps going lower and lower and lower. You could be 20, 30 years and the stock market may never eclipse the previous all-time high. The Great Depression, I think, took 27 years, and the Great Recession took about 13 years to stay above the previous all-time high. So whenever you have a stock market that gets bid up so quickly like this, all right, just like we have here in the U.S. with the NASDAQ and S&P, recently making new all-time highs and essentially rising vertically, you have to think to yourself, is this a near-term top for the next decade? All right, so definitely something to consider. I'm not saying it's going to happen. I'm definitely betting on the U.S. economy. I don't want to see the U.S. economy fail. But these are things that affect our families, our finances, right? So definitely something to keep in mind about this chart here on the Nikkei and the previous history during the Great Recession and Great Depression. Let me take a look at the unemployment rate, okay? So as you can see here, this is the unemployment rate from the Civilian Unemployment Rate Bureau of Labor Statistics. All right, this is what all of the financial analysts are looking at, and you can see here that the unemployment rate has ticked up to 4.3%, okay? It was essentially near, I don't want to say all-time lows, but very close to all-time lows down here around, let's see, about 3.4, 3.5, somewhere in this area. Very healthy, but at some point, it tends to go up. You can see back here in the 60s, it was around the same level, and you saw a huge spike. This caused the big inflation in the 70s. Okay, you can see the unemployment here rate in 06, just before the Great Recession. Huge spike caused the Great Recession. All right, people started to get hired again, and here's COVID. Okay, and again, people were unemployed during COVID because, again, this was the largest unemployment, I think, since the Great Depression because we were locked down. So pretty interesting to pull this up and see how it correlates with the U.S. stock market. Basically, as you start to see unemployment tick up, okay, tick up, tick up, tick up, all right, in the past, you see usually a vertical rise in unemployment, and that typically correlates with a drop in the stock market. So generally the labor market, from what I've learned, is the last to crack. All right, and it's terrible to think that we'll see likely more unemployment in the U.S. and likely globally. But this is something to keep an eye on. If all of a sudden we inch up to 4.75, 5% unemployment, the markets will get scared. And really what they say is, okay, people, companies are laying people off. They don't have enough money to spend, so corporate profits will likely be lower, and therefore earnings reports will come in lower, and people start selling the stocks. The stock market and investors are forward-looking. They're looking 6, 12 months ahead, and they are looking at all of these things, and they are keeping a very close eye on these numbers, as well as the jobs report, CPI. At this point, I think that the CPI and the Fed, right, has seen these numbers, and they say, okay, we're likely to start to cut rates. We're likely to see a rate cut in September. But again, historically, when the Fed has cut rates, typically a recession has followed every single time that the Fed has kept rates at a very high level and then started to cut. Go back, look at an article on Market Watch. I've also written a couple articles on the website about this, verifiedinvesting.com. So this is definitely something, a turning point, I think, in the markets. And you can see here that as unemployment rate starts to spike, we can go back to our parallels on those charts and see how it would likely continue lower, to those support areas. So very good. I hope you enjoyed that. I really kind of tried to give an overall picture of what I'm seeing in the markets, and unfortunately, what is likely to start the beginning of a bear market. That's my take. Again, I could be wrong, but based on the data that I'm seeing, that's what I'm thinking. So, very good. So I hope you enjoyed that. I do a market update every couple weeks, especially after there's such a big seismic shift in the markets. Again, to have the NASDAQ down 6+% yesterday, the S&P down 4.5%, that is huge for the markets. That is not common at all. I haven't seen that actually in my trading career, in my investing career. So this is potentially, again, a change in the market. So stay tuned. We'll try to do some education next week. And again, if you haven't seen the previous episodes and learn the details that I've taught over the past several months, go back and watch those episodes. And then again, if you want to learn how we trade, I have a 1-minute scalpel course. Look at the QR code or the links below. You'll be able to see, my course, what I do in that course. I use it every single day in the Apex Day Trading Room. If you want to be surrounded by professional traders, people who have done this for collectively now, decades, 3-4 decades, join the Apex Day Trading Room. And there's a lot of great educational material on the Verified Investing site. So I hope you enjoyed it. I'll see you again next week. Take care.